December 15th, 2023. Bear bar on bar one. In general in the day, we were coming in today in an area that was probably a trading range. You know that this was a magnet and you know that this was a magnet because bears who sold this close technically did a reasonable thing. It wasn't great because it was a breakout below a channel, so it was pretty climactic, but this is still a magnet and it still is right now. So if we test down here at any point, expect buyers. And generally, same thing up here. Traders who bought this close did something reasonable, so they should be able to get out a break even. And you can see when we reached that price, we started to find sellers. Bar one, bear bar, but a tail on the bottom, probably buyers below. And you can see there were buyers below on two, but two is a doji bar. You don't really want to buy above two. And anyone who did was probably disappointed in the way three closed, and so a lot of those traders are exiting. You can see below three, there were buyers, so tight trading range open. Generally, when you get a tight trading range open, it's going to be an overall trading range day. I should have tight trading range opens in here. TTR opens. So just a couple examples. Tight trading range on the open, trading range day. Tight trading range on the open, trading range day. Tight trading range on the open ends up being a trading range day. So you can see, for the most part, when you get tight trading ranges on the open, it's pretty much, almost always going to be some sort of trading range day. So when we get the tight trading range on this open, you should be expecting a trading range day. You can see, it's kind of opposite always. When you get a tight trading range, there are going to be buyers below three. There are going to be sellers above four, right? So you want to sell the tops of the tight trading ranges and buy the bottoms. Probably buyers below five during six. You can see that. Inside bar on seven, but not really a good buy. It's maybe one, pullback two, pullback three, but I don't want to buy above seven. I think it's, there's a big tail on top of the bar and you're buying high in a tight trading range, so not that good. Follow through for the bulls on eight, but again, a tail on the top, so I would just remain flat. It could be, something like, one pullback two, so really not all that good. You can see that nine traded down below eight, so the bulls, they're willing to buy below eight or, buy down here around this low, and they probably would have bought more lower, but it doesn't trigger. Bull bar closing near its high on nine. It's kind of a bull surprise and probably enough for a second leg up, but I don't think I want to buy it. You're still overall the top of a tight trading range. It's probably reasonable, but this just isn't great trading. We're starting to develop a bull trend line, though, after we get the doji follow-through bars. You can see doji here. So you kind of have to be, you're probably expecting bad follow-through, though. If you bought above 9, you're probably expecting a bar like 10. And you can see pretty much any trader who bought any tick on the way up during 10 got out at break even during 11 because they were disappointed in how 10 closed. Bull surprise on 12, probably enough for a second leg. Just seems like a vacuum test of this close. And bad follow-through on 13. It seems like bulls are going to be selling new highs and buying pullbacks today, or at least, at this point. Bad follow-through on 13. Inside bar on 14 and, micro double top 15. It's a double top with 13, and it's essentially a 3-bar reversal. But I don't think I want to sell below 15. You're selling right on a pretty tight bull channel line, and you're selling after a good pair of bull bars. And if you're selling below 15, what's your premise? Well, your premise is that we're going to get strong follow through on 16 and we're going to get a strong breakout maybe somewhere down here. Or, maybe you're looking for a measured move down of, the wedge, which leads you to around there. But the reality is, if we're going to get that, which we would occasionally, but not very often, but if we're going to get that, then 16 is going to be a strong bear bar closing near its low too. But that just doesn't happen very often here. So it makes more sense to sit out at 15 and wait. And then when you get 16, it's a tight bull channel still, and you're buying a pullback in a tight bull channel. So I think 16 makes a lot more sense to take the buy. Your 2-to-1 of 15 is basically a new low on the day. And, I don't know that it gets there all that often. Probably does 40% of the time, but I just don't think it's very good right on the channel line. Versus your 2-to-1 up here is only up here, so it's not nearly as far. It's a smaller bar, smaller risk, but I think the context makes the probability reasonable to buy above 16. You get good follow through on 17 and then disappointment on 18. You can see the bulls who bought above 16 were scalping out with 4 points. Why 4 instead of 5? Well, look at the overall daily range so far. So when you're buying above 16, the daily range is 15 so far on the day, versus when it's 5-point scalps, a lot of times the daily range is a lot larger. So the daily range is pretty small, so traders are willing to take a bit less. So traders are scalping out with 4 points up here instead of 5. Disappointment on 19, so any bull who bought the close of or above 17 is disappointed in 18 and is exiting around break even during 19. And then you get a big bear surprise on 20. It's a strong bear bar, but really, the important thing I think is that it's breaking the channel line, the trend line. So it breaks the trend line on 20, but a big tail Likely that we're going to get a retest, and this should lead to a lower high. It's strong enough that it should, or it might, test exactly. It was a lower high this time, but a lot of times it'll test exact. Bad follow through 21. We're probably going to at least get back to the 19 low. The bulls who bought below 19 in skill and lower should be able to get out at break even. 22 is a double bottom. Bulls are hoping that we're essentially going to get a breakout above the wedge and a measure move up. Bears are hoping to form a lower high. 23, a bull bar, maybe a reasonable buy. It's an inside bar, but if you're buying above 23, you want explosive follow through on 24. And the reality is, if you get it, you're probably going to scalp out. So I don't think it's all that great. 25, it's a double top, lower high, major trend reversal for the Bears. The Bulls see it as a pullback after 4 straight bull bars, so they're hoping they're going to get another leg up. And you can argue that, these 4 bull bars should get another leg sideways to up. And I think the tail up on 26 was the sideways leg. Bulls who bought any of these higher ticks were able to get out at break even during 26, and you can see they sold. So that's what caused that. Now the Bears have a strong signal bar and double top, lower high, major trend reversal. So I think it's a good swing sell. Follow through on 27 and 28, but it's just not all that great. Sometimes you're going to get kind of bad follow through like 27, but I'd prefer it to have closed below the moving average. And then on 28, you wanted to see something more explosive. This is the neckline of the double top is the 21 low, 18, 26 double top. So you wanted it to close below the 21 low at some point, maybe not on 27, but ideally on 27, but if you don't get it on 27, ideally on 28, 29, you want it to get down through the neckline and find out what's there pretty quickly. And it just wasn't able to. We get doji bar on 29 showing just a real lack of interest from the Bears. This is strong enough for a second leg down, but that might be all you get. 30, a reversal up. It's a double bottom for the Bulls. They're hoping for a swing up and a measured move, but probably not going to get it. Bad follow through on 31, and essentially a double bottom with 30 on 32. Hoping 2 legs down at the bottom of a trading range, looking for buys, but probably not going to get very much follow through. Big tail on the top and tight trading range. Bad follow through on 33. A bull bar on 34. I think a lot of Bears, any always in short Bears, the last ones at least, would be exiting above 34. And then you get an inside bar on 35, closing near its high. So I think definitely always in short Bears are going to get out above 35. But the problem is, it didn't trigger above 34. So I think 35 is a reasonable swing buy. But the problem is you're buying at the top of a trading range. So you have to be quick to get out and quick to make decisions. And you can see 36 wasn't the follow through that the Bulls wanted. If the Bulls are buying above 35, they wanted a good bull bar closing essentially near or on its high, closing above the high of the day. And they're not getting it on 36. And that's why you get a micro gap down here, is because Bulls, what was the close of this? And the open of it. Okay. And then the Bulls realize they're not getting it on the close of 36. And so they just exit at the market disappointed and take a tick or two. And that's what causes this bar on 37. Any Bulls who are still long are going to be exiting below 37, so Bears can sell. Follow through 38, 39, 40, but big tail on 40, tails on 38, 39. These are probably okay sell to close bars, 38, 39, but it's difficult to do with the tails and the bottom of an overall trading range. And then a big failed breakout on 40. 41, good swing sell, potential second leg trap, potentially the middle of a trading range, but it's a midday swing, and we still haven't broken out of the 18 bar range yet, so it's logical to think we're going to get down here. Follow through on 42, but it's really not what you want. If you're selling below 41, you want 42 to be, a bit better. You want it to be closing nearer on its low, and you want it to be a bit bigger, maybe somewhere down here. You're hoping to get swept into a big trade that's going to bring you somewhere down here. And 42 isn't really giving you that confirmation. And then you get more disappointment on 43. Traders who sold below 41, disappointed, kind of disappointed in 42. It's a good enough bar, but a lot of them see it and they're thinking still trading range, second leg trap, and they exit around break even on 43. Doji follow through on 44. This is tight enough for a second leg down, so you're probably not going to buy above 43. 45 is a double bottom, but again, this is pretty tight, so it's kind of hard to want to buy above 45, I think. I'd rather wait. And disappointing follow through 46. Bull bar 47 and 48. I think 48 is not a very good buy. You're buying in the middle of the middle of an overall trading range, right? So you're buying actually above the middle of an overall trading range. So you're kind of buying high in a trading range, and you're buying after this strong climax, and you're essentially buying 1 pullback, 2 pullback, 3. So you're buying a third push up, and these, 47 isn't an ideal bar. These aren't ideal 47, 48. These aren't ideal bars. So traders are hoping, if you're buying above 40, 47, 48, you're hoping that you're going to essentially get a pretty quick vacuum test of the 36 low or close. And you just don't get that very often. And so many times, I've taken this kind of buy a billion times before. I can't even, remember how many times I've taken this, but I did not yesterday, for those reasons, in the, middle of a trading range overall. And 49, disappointing follow through. So if you bought above 48 and saw 49, if you bought above 48, you wanted to see a big vacuum test and you didn't get it on 49. So those traders are just going to flatten. And that's what happened on 50. It's a trading range, so risk happens pretty fast. And this still probably deserved a better second leg than the sideways leg on 45. And that's probably what we're getting on 50. Bulls are exiting their longs. Anyone who's still long is going to exit basically on the close or below here. Basically, this is a breakout point, right? This low, so traders sell below it. Big follow through on 51. A couple of really good sell, strong bear bars. You could sell the close of 50 or 51, but you have to keep in mind that you're selling on what's probably a trading range day. It's possible we collapse down, and if you sell down here, you're betting that we collapse down. But then you get 52, and 52 is just a really disappointing bar. If you were selling, you're hoping that you finally got the big breakout you wanted and you're going to get down to this close, but instead it ends up just being a second leg trap. I'm not sure if it's exact. It's not. But it ends up just being a second leg trap and you see 52. And I think bears are going to exit above 52, just disappointed in how it closed. It's too strong, and it's a reminder that we're still in a trading range. 53, test down around the 51 low, probably going to find some buyers. And you can see the problem with buying with 52, it's a trap. It's potentially a bear trap and we could go up. But a lot of times, this is going to get another leg down. So again, trades directly below 52, traps out the bulls who were long, and then starts to trade in their direction, which is pretty common on trading range days when you're using tight stops. So 54, probably more buyers below 52 than sellers because of how strong 52 closed. Inside bar 50, 56 or 55, 56, but tight trading range, I'd rather wait. Follow through 57, 58, but not all that good. Big tail on 57. It could be one pullback two. 59, a bear bar closing near its low, but the top of an overall trading range, but you're selling in the middle of a tight trading range, so it might not be all that good. It's a failed breakout above the II, so you're hoping for essentially the failure and then a trade down and follow through on 60, but traders end up just seeing this as the bottom of a trading range because bulls have bought it so many times, so they scalp out around break even, and that's what causes 61. And so the failure up, you get a failure up and then failure down, so the failure failed. And essentially, we ended up getting a double top of 68, but not all that good. The neckline's way down here, and you can see bulls don't let it trigger. Any bulls who were long definitely would have exited below 68 had it triggered, and then we ended up getting a vacuum test up late in the day. Overall, this was a difficult day. I think that it's good stop orders are 16. You probably have to get out below 19. Probably 26 is a good sell, but you're probably going to get out somewhere in here. Maybe you could probably buy above 35. But, get out below 38, maybe, or 37, maybe sell below 37, probably sell 41. I probably wouldn't personally take anything in here. The daily chart, we had an inside bar. We could get, a strong move down on Monday below that inside bar. I'm not so, I think it could end up looking something like this, actually, like over here, where you get an inside bar and then collapse down. But I think the move overall is strong enough that any sort of reversal down will be minor. I will not be here on Monday, so there will be no review on Monday. And Tuesday, I'll see. It's getting towards the end of the year, so I'm going to be pretty spotty for the rest of the year. But anyways,